We all know that the key to compounding is to invest for the long term and invest consistently. When the market goes up, you buy. When the market goes down, you cry a bit, then you buy more. But sometimes, some protection is always nice, especially when the markets feel uncertain and you want to protect your profits. That's why in this video, I will show you 3 option strategies that you can use to protect your portfolio from a market crash. So let's start with the simplest strategy, buying a put option. With a put option, the more the underlying falls, the more valuable the put becomes. This means your losses on the stock are offset by the gains on the put. For example, here we have Nvidia, and we can buy a put with a $170 strike price. If we take the mid price, this put will cost about $4.75 per share or $475 per contract. With this put, the lower the stock goes, the more we profit. So even if the stock crashes all the way to zero, our losses are capped. However, the problem with this strategy is that it is expensive. This put option has 37 days to expiry, so it gives me protection for 37 days. However, if the stock does not crash over the next 37 days, the maximum loss that I will get is $475. So if you are paying $475 to protect a $17,000 stock position for just 37 days, that is a 2.79% cost for slightly over a month. If we analyze that, it works out to about 27.6% per year, which is super duper expensive. And this does not even take volatility into account, because when market volatility increases, put options will become more expensive. This usually happens when the stock is crashing. So right when we need protection the most, you could end up having to pay more for the protection. Now, one way to reduce the cost, at least in percentage terms, is to go for longer dated puts. For example, instead of a 37-day put, we can buy a put that expires in about 1 year. At the same $170 strike, this put will cost around $22.60 or $2,260 per contract. In absolute terms, yes, the cost is much higher, but in percentage terms, it is only about 13.5% for a full year of protection. Nevertheless, it is still quite a high price to pay for insurance. At this point, you might ask a question. If buying a put is basically the same as having a stop loss, doesn't it make more sense to just use a stop loss instead? After all, a stop loss is free, whereas a put costs money. Yes, while having a stop loss does not cost anything, the problem is that a stop loss forces you to exit your position completely. So if ever the stock hit your stop loss and then immediately rebounds, you will miss the entire recovery. On the other hand, with a put, you do not need to sell your shares. Instead, you can hold through the dip and still benefit if the stock recovers before the option expires. So in that sense, a put gives you protection without forcing you out of the market. But of course, puts are not free, they cost money, and over time, that cost can add up. So one way to reduce this cost is to use the next strategy, which is a put debit spread. Let's go back to the 37 TTE and reselect the put at $170 strike price. But this time, instead of stopping there, we can also sell another put at a lower strike price. Let's try selling the $160 put. By selling this put, we get to collect a premium. This helps to reduce the total cost of the hedge. In this case, the maximum loss drops to about $222. This is much cheaper than just buying the $170 put on its own. However, this also comes with a trade-off. Because we sold a put at $160, our protection is now only capped to $160. So if the stock falls past $160, we will no longer get additional protection. This means unlike buying a single put where your protection is uncapped, this strategy does not protect you against an unlimited crash. Instead, it only protects you within a fixed range. Now, if you want even more protection, we can move the short put further down to say $150 strike. This gives us protection over a wider range, but it also increases the cost. In this case, the hedge now costs around $346. And again, if we want even more protection, we can shift the short put even lower, but the cost of protection would go up even more. This strategy makes protecting your position much more affordable, but in exchange, the protection that you get is limited. But this isn't necessarily a bad thing. This strategy works well if you expect the stock to fall only within a certain range. For example, if you only expect a moderate correction, such as a 5% or 10% drop, in that case, you can set up a put debit spread to cover just that range. This will make the hedge much more cost effective as compared to buying a put outright. Now, if you want to implement this strategy effectively, you need the right tools, and Moomoo is one of the best platforms for doing this. First, it lets you easily build option strategies based on where you think the stock might go, bullish, bearish, or sideways. Moomoo automatically generates all relevant option strategies for you. Each strategy comes with a clear P&L payoff chart, and you can visualize the payoff instantly before you even place the trade, so you know exactly how much protection you are getting. Second, Moomoo has a built-in P&L analysis tool. It draws the payoff diagram for you instantly. For example, you can simulate if the option drops 10% next week, what is my put option worth? This is crucial for knowing your hedging coverage. They also show you unusual options activity, so you can spot when big money is moving into certain strikes or expiries. Buying a put option is also about timing. Moomoo supports advance orders, so you can automate your trade entries or exits based on complex triggers, ensuring you get through exactly how you plan. And finally, Moomoo has some of the cheapest options fees out there, and you can choose between fixed or tiered pricing to get even lower costs depending on how often you trade. If you sign up using my special code, you get to enjoy up to 2,200 ringgit rewards, which includes 200 ringgit cash coupons and Apple shares, as well as up to 6% per annum for Cash Plus. So if you are interested, click the link down below to try it out right now. However, what if you want unlimited protection, but at the same time, you don't want to pay for it? Wow, so good ah! Yes, this strategy exists, and it is called a collar. Again, let's go back to buying a put at the $170 strike. But this time, instead of selling another put, we sell an out of the money call. So because the put that we are buying costs around $4.80 per share, what we want is to look for a call that we can sell to partially cover or even completely cover the cost. For example, selling a $195 call gives us about $5.60 per share. When we combine both trades, we can actually receive a net credit of about 90 cents per share or $90 for 100 shares. This means we get unlimited downside protection and we do not even need to pay for it. Now, of course, that goes without saying that the call must be covered, meaning we need to own 100 shares before we can do this strategy. If we sell a call without owning 100 stocks, it would be a naked call. And being naked isn't always a good thing, especially in this case, as our loss would be unlimited to the upside if the stock ever goes up. So let's switch over to the profit and loss chart. Let's also include 100 stocks to this so that we can see what the full profit and loss looks like. So what you can see is that even if the stock crashes all the way to zero, we don't have to worry because our loss is capped. In this case, the maximum loss is about $1,298. However, the trade-off is on the upside. In this case, since we sold a cover call at $195 strike, once the stock goes past $195, our profits will be capped. So even if the stock rallies all the way to $500 or $1,000, our profit will stay the same. Now, of course, there are a few ways to manage this. The first option is to shift the call to a higher strike. The higher you go, the more upside you will have. But that also means that you may go from receiving a credit to paying some upfront costs. The second option is to roll the call up and out. Basically, as the stock goes up, you can buy back your current call and sell a new one at the highest strike and later expiry. This lets you adjust your upside as the stock goes up. However, this only works if the stock moves gradually. If the stock gaps up very quickly, you may not be able to roll fast enough without paying a high price. So there you have it. These are the 3 strategies that you can use to protect your portfolio from a market crash. With a put option, you get unlimited protection. Your downside is limited and your upside is uncapped. However, the disadvantage here is cost. To use this strategy, you need to pay a premium every time, and it can be expensive, especially if you do it over the long run. This strategy works best if you are worried about a near-term crash and want full protection, but at the same time, want to leave room for the upside in case you are wrong. As for the put debit spread, you reduce the cost of hedging. You still get downside protection, but only within a fixed range. The trade-off is that your protection is capped. This strategy works best if you expect a moderate correction and want a more sustainable way to hedge. And lastly, with a collar, you get protection at a very low or even zero cost. The downside is that your upside is capped. This strategy works best if you want to limit your downside risk and you are comfortable with giving up some upside in return. In short, there's no perfect strategy. Every hedge has a price. You either pay with money or you pay with opportunity. Anyway, that's all for this video. Like, share and subscribe as I'll be posting new videos every week.